Hi, my name is Dr. Ola Brown, and in this short video, I'm going to be taking you through some of the most interesting articles that I read in 2023 about the VC industry. So I'm going to do a bit of an introduction and then tell you a bit about me, and then we'll go into the articles. So introduction to the VC industry. Why am I so passionate about VC? Why am I always speaking about VC? I think the most extraordinary thing about VC for me is the effect that it really has on the economy. So venture capital investments only make up 0.2% of GDP, but deliver an astonishing 21% of GDP in form of venture-backed revenues. When you look at the stock market, for example, in the US, you see almost half of the US stock market currently today is companies that were backed by venture capital. When you look at employment, for instance, over 15% of new employment generated in the in the US is from venture-backed companies. So imagine if VC did this for America, imagine what it could do for Africa in solving our problems of unemployment, insecurity, as well as giving us a comparative and competitive advantage in technology to provide solutions for the world. So who am I? My name is Dr. Ola Brown, and as you may have guessed, I invest in Africa in two sectors, health tech and fintech. And we invest with a focus on the main four economies of Africa, Nigeria, Kenya, Egypt, and South Africa, that together make up 50% of African GDP and 60% of Africa's consumer markets. I am a doctor, a medical physician. My bachelor's degree is from York in medicine and surgery. My master's is in finance and economic policy from the University of London, and I'm completing my PhD in finance from the University of London, focused on financial technology and monetary policy. So the first article was compiled by McKinsey & Company, and it's called Fintex, A New Paradigm of Growth. And I love this article because I run a specialist fintech and health tech investment platform, so obviously I'm always interested in fintech. But I love the way that this particular article was actually integrated and looked at the workforce, for instance. It looked at the relationship with the banks, and I thought it was really holistic. So you can download it actually for free on the McKinsey website. You have to give them your email address. So Fintex, A New Paradigm of Growth. So some of the big numbers that this article shared. In 2022, Fintex accounted for 5% of the global banking industry's net revenue. So it's estimated that this share could increase to $400 billion, which is 15% of the annual rate of fintech revenue between 2023 and 2028. So in 2022, it was 5% of the global banking sector's net revenue. The demand and need for fintechs is actually higher in developing economies. So in 2022, for example, Africa had 800 million, so almost 1 billion mobile accounts. That's almost half of the world's total mobile accounts. Now, as of July 2023, there were 272 fintech unicorns with a combined valuation of almost $1 trillion. That's a 7-fold increase from the 39 firms that were valued at $1 billion 5 years ago. So in the past 5 years, it's gone from just 39 unicorns to 272 unicorns. Revenue in the fintech industry is expected to grow 3 times faster than those in the revenues of the traditional banking sector. So fintech is also faster growing in terms of revenue. 73% of the world's interaction with banks now takes place through digital channels. So fintech and financial technology has disrupted and will continue to disrupt financial services in the banking industry. So based on the growth expectations in the fintech industry, which are projected to be 3 times faster than the traditional banking sector, there are 3 themes that McKinsey says will continue to shape the next chapter of fintech growth. Number 1 is that fintechs will continue to benefit from the transformation of the banking industry, meaning that there's a lot more disruption to go because the banking industry is huge, and fintechs will continue to eat into that share of market. Number 2, fintechs themselves still have room to grow. So people think that fintechs have kind of reached their peak, but McKinsey is saying that in the short term, even in the short term, they still have a lot of room to grow. And this market correction, according to McKinsey, isn't actually going to affect all fintechs equally. There are fintechs at particular stages of their growth that are going to be more resilient than their peers. So this is still a great time to be investing in fintech. So it also sort of explores and gives advice to founders of fintechs about what strategies they should be exploring. Number one, measured growth on a stable core, which is what we've been sort of saying in other videos. Not growth at all costs, but measured growth from a really stable core of recurring business. Programmatic M&A. So I think in the past we've seen a lot of acquisitions for acquisition's sake. But what McKinsey is saying is don't acquire as a response to a low valuation environment. Require with a strategic mindset, focusing on companies that can really add value to the core company. Cost discipline, we've spoken about this over and over again in the other videos, and McKinsey has highlighted it as a trend. Resilient companies are going to be capital efficient and have cost discipline. And keeping culture alive. The importance of culture can never be underestimated, particularly in a market downturn. So that's my summary of the article from McKinsey on Fintex. The second article that I found really interesting was published in TechCrunch, and it's called Innovation and Investment in Maternal Health. Again, free to read on TechCrunch. So I think, one of the more shocking statistics was, according to the CDC, which is the Center for Disease Control in America, US maternal mortality rates have reached 40%, meaning pregnancy is now far more dangerous than it was for mothers. Or have not reached 40%, that would be a disaster, have increased by 40%. So with all the innovation and all the money that's going into healthcare and, all these weight loss drugs coming out and, solutions for male balding so that people can actually put hair back onto their heads, you would think that, sort of our most basic human function, giving life, would be getting easier. But actually, maternal mortality, more women, even in the United States of America, are dying. And maternal mortality has increased by 40%. The maternal mortality crisis is even more devastating for Black women. So Black women are actually 2.5 times more likely to die from pregnancy or something related to the pregnancy than white women. And this is the most heartbreaking thing of all. 80% of these deaths are preventable. That means we know how to prevent them, and we're just not doing enough. This article also highlights something that I've always believed, that women's health is one of the most underinvested and underserved areas of healthcare. And there's a huge financial and impact incentive to focus on women's health. Number one, there's a huge opportunity for innovation, particularly with the sort of acceleration in AI solutions. Number two, investing in women's health is actually like an impact-driving investment. The market opportunity is substantial, 4 million babies born annually in the US alone. So it's a huge opportunity for profit and impact at the same time. So I think the takeaway from that article is that women's health is probably the most underserved and underinvested area of healthcare, and there's a huge opportunity to make profits and make impact by investing in women's health. The next article was actually from an investment company. It's called, the investment company was called Verdis Investment Management, and the article was, it was a LinkedIn post by a gentleman called Akhil Paul. And he spoke about his investments in funds and some of the trends that he had seen, and I thought that this was super interesting. So Verdis Investment Management had a really unique approach to the market. They wanted to capture the mean return of the early stage venture ecosystem, and they wanted to get the maximal returns from this asset class. So they did a study, and they looked at all the venture returns from 1990 to 2017. And what they found out was the internal rate of return for US venture funds was at the mean, 50%. Mean. While the median was just 10%. That indicates that the top funds and the top fund managers perform significantly better than the rest. They really outperform. And the median is horrible. So they had to target the mean, because the median return is lower than most private equities and lower than the S&P 500, which have less downside risks and more liquidity. So they decided that they were going to capture 20% of the US seed ecosystem. And they were going to do that because that would provide a 95% confidence interval of catching that mean return that they were looking for. So they focused on the US ecosystem, and what they did was deployed capital across 20 different funds between 2017 and 2020. So invested in 20 different funds with the aim of catching 20% of the seed ecosystem. So through those investments in 20 funds, they got exposure to 1,200 startups and achieved 38 unicorns. And get this, 50% of those unicorns they got through investing in first-time managers, not more established managers. Now, when they looked at the portfolio, they revealed, the analysis that they did revealed that, you know, for them and for their investment, remember, they only invested in 20 funds, but when they looked at the 20 funds they invested in, there was no real difference in strategy. So there's a big debate in venture capital. Some African funds will do 150 deals in a fund, and that's called a diversified strategy. Some funds will do 6 and do 6 high conviction deals. So some people would raise a $20 million fund and say, I'm going to go with a high conviction strategy. I'm going to raise $20 million and I'm going to put all of that money into 10 deals of $2 million each that I have high conviction about. That's a concentrated strategy. Whereas others would say, I'm going to raise $20 million and I'm going to invest 100,000 in over 100 deals. That's a more diverse strategy. So there's a big debate in venture capital as to whether a concentrated, focused strategy is better or a diverse strategy is better, where you have a lot of portfolio companies. And what their analysis revealed is that a diversified strategy actually has lower volatility and a smoother return profile compared to a concentrated approach. Although the concentrated and diverse funds that did well did achieve similar returns over time. So that tells investors that your tolerance for volatility should guide you when you're allocating to funds. And if you don't want that volatility, you're better off with a more diversified fund. So that was the investment company LinkedIn post. The next one was Revere's benchmarking report 2003. And that was compiled by the co-founder of Revere. It's a software company, and his name is Eric Wu. And it was published on their website again. You can download this for free on reveres.com. Now, he looked at TVPI, so the amount of money, unrealized, of course, that venture capital firms make. And what he was looking for was trying to compare diverse GPs, so minority, Black, brown, Indian, people that run venture capital firms, and women that run venture capital firms, to the general kind of people that run venture capital firms. And what he found is in 2013, their diverse data found that diverse GPs delivered a 2-point 3.86x return, whereas women delivered 3.59x return. So the total quartile for GP performances, or the top quartile for GP performances, was 3.2, let's round it up, x. Whereas it was 4.5 for women. So in 2023, he found that diverse data was good. So this was diversity in any way, shape, or form. But actually, women outperformed in 2013. Now, in 2014, funds did better. The median TVPI was 4.7, and the top quartile was 5.4. And again, he looked at diverse GPs, and he looked at women. And in 2014, he found a 5.3 return for diverse GPs and a 5.3 return for female GPs. Moving on to 2015, in this particular vintage, actually, the women did not as well as in previous vintages. Whereas 2016, funds run by women outperformed again, giving a 6.8x top quartile TVPI, the highest TVPI in all the data that they analyzed. Now, what does all this mean? The improved performance that they saw in 2013 to 2016 is attributed to the rise of emerging managers, many of them who transitioned from senior tech roles like Twitter and Facebook into fund management. That influx of fresh capital, coupled with the diverse backgrounds of new managers, really altered the venture capital landscape. So favorable macroeconomic conditions and prolonged private holding periods really helped these new managers to thrive. And the most interesting thing was, despite the underrepresentation of women in venture capital and insufficient funding for women fund managers, they outperformed in the top quartile, regardless of these constraints. Another thing that Revere looked at is solo GPs versus multiple GPs. And we'll go through that data now. So what Revere found was that in the past few years, as we've noticed, there's been a notable increase in solo GPs. Sometimes they break away from well-known VCs. Sometimes they go sort of the PR route and have had a podcast, and then they raise a fund based on the followers of the podcast. But interestingly, I think the thing that was interesting is that solo GPs are seen as more risky. And the sort of overriding notion in the industry is that solo GPs are sort of less reliable and will get less returns than when you have multiple GPs running a fund. In 2018 and 2019, which was slightly unbelievable to me, solo GPs actually performed significantly better than funds with multiple GPs. And what Revere actually sort of attributes this to is simplified decision-making and ability to execute investments faster than when there are multiple decision makers, which is important in VC. So I've analyzed quite a few articles, and I'd like to give founders watching this video some takeaways from those articles. Number one, focus on building a strong, stable core business with market fit as soon as possible before expanding. And that's really from the McKinsey article, where it says grow from a strong core. Pursue strategic M&A, not M&A because valuations are low, but M&A because this asset that you're purchasing can really complement your business in some very thoughtful way. The McKinsey article also spoke about cost discipline, remaining flexible, nimble, and compliant, as well as keeping that OPEX down. And preserving company culture. One of the main advantages that small companies have over big companies is that culture of innovation, that agility and that speed. So keep that alive as long as possible. And some advice for investors, based on the articles again. We spoke about the fact that women and diverse managers actually outperform. So when you're looking at funds, try and invest in a variety or consider a variety of funds, including those run by diverse managers and those run by women. Consider investment in funds that support women's health, because this is an underserved and under-researched area with particular significant potential for both profits and impact. Number 3, look at solo GPs, because they've shown really strong performance in the past few years. So don't dismiss the solo GPs. And then 4, think about fintech. Fintech is projected to expand nearly 3 times more than the traditional banking sector. And that's a huge area where we're going to see disruption and growth in the next few years. I'm just going to say a little bit about my fund, HealthCap. We're a Pan-African fund focused on health tech and fintech, and we currently focus on the big markets of Nigeria, Kenya, South Africa, and Egypt. Opportunistically in other African countries, we have 18 portfolio companies already. 50% of the founders we invest in are women. We've created 1,000 jobs, 12,000 indirected jobs, and our aim is really to create a healthier, wealthier Africa. If you want to learn more about HealthCap, visit our website, HealthCap Africa. If you'd like to reach out to us and learn more about investing in Africa, investor.relations@healthcap.co. And if you're a founder building in Africa, either in the fintech or health tech portfolio, email us your deck. You don't need a warm introduction to connect with us. It's pitchdecks@healthcap.co. So overall, what have I said? I think this presentation provides some insights into the venture capital landscape and how it's changing. Talks about fintechs as a force of growth in the world and a force driving global prosperity and the potential there. It talks about women's health as the most underserved and most sort of under-researched area of healthcare, and how women's health investment opportunities provide potential for impact and profit. I spoke about the fact that women GPs have outperformed the Cambridge Associates benchmarks in the vintage years that I spoke about, according to data compiled by Verdis. And it also highlights things that we don't typically think about, like the performance of solo GPs and diverse GPs as well. This information is crucial for investors and also for industry professionals wanting to comprehend the continuously evolving dynamics of the venture capital space. I hope this has been interesting and useful and given you some things to think about. Thank you.